Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, the truth about your IRA, part 2 in our series on retirement tips for seniors with registered financial consultant and investment advisor representative, Ted Meyer. Welcome to the second segment, Ted.
Thank you, Steve. Always good to be here.
Well, you know what's good about, we are truth, full disclosure, Mr. Caveat. Your practice is tell it all, lay it out there. Listen, we all have expenses, can't escape that. We talked about that in the first segment. Now, the truth about the IRA, at first when I saw your title, I was like, well, wait a minute. The IRA is so straight up. It's so simple. What, is there some truth that I'm not aware of? Because here's the thought. I want you to think about this as the audience. What if you believe something to be true, but it wasn't? When would you want to know about it? I think I'd want to know now.
I think I'd want to know right now.
Yeah.
And that's what it's funny. We've been on this topic now I've been an advisor for almost 15 years now. We've talked about IRAs, and there's a famous speech out there Lou Holtz gives that if you're not growing, you're dying. Mm-hmm. And so as a firm, we're always trying to invest in ourselves and understand more and more. And this topic of your IRA came up probably about 2 years ago. And the last 2 years, I've asked this simple question, and I've yet to have anybody answer it correctly. And I won't put you on the spot, but here's what it is. We go to these seminars, we're talking to folks about their IRA, and we ask everybody very simply, what does IRA stand for? And I've never had anybody tell me what the actual answer is. Everyone stands there and says, my IRA stands for individual retirement account. Well, if you pull up the tax code, and the tax code is, for all of you out there, is 590A and 590B, your IRA is actually titled an individual retirement arrangement. It's an arrangement between you and the IRS. And when we go out there and bring that paperwork to folks and show it to them what's going on, every single one of them says, I'm in an arrangement with the IRS. And that's exactly what it is. They're in charge. Your name is on the account, but it's the IRS who gets to dictate how much you put away, how much you take out, when you can take it out, how much you're penalized if you don't take out the right amount. And so everybody has this account. Everyone has an IRA, whether it's your 401k, 457, you roll it into an IRA. But very few people truly understand how to accumulate money inside of there and how the distribution side of it works.
Okay, so here's what I'm hearing you. I'm surrendering my control to the government under the ERISA regs so that I can get a tax deduction. I mean, that's what the trade-off is, right? I'll submit to your regulations, and in turn, you're going to give me a tax deduction.
Correct. And it made a ton of sense back. They started IRAs back in the late 70s, when back then, that's probably more early 70s, the highest tax bracket was right around 70%. So an IRA for high-income earners made a ton of sense. I'm going to defer the tax on it today. I'm going to put it away. And then when I'm retired 20, 30, 40 years down the road, my taxation should be less, and I'll take it out then. So it made a ton of sense. That's exactly what they did. They surrendered that over. I'll take it out later. That's where we find ourselves today.
Okay, so I just want to make sure it's clear, because I've written on this 100 times in my career. You need to find out, and not many clients do, they need to know their effective tax bracket. Most people don't know that. If you could know that, it'll make a first decision is, wow, I'm not really in that high tax bracket. Should I be in a 401k, a 457, or an IRA at all then?
Right.
But most people say, and I'll give you this, if you're getting a match from a 401k from your employer, I'm all over that. Take it, run with it, it's great. But anything above that, if I'm not in a high tax bracket, I don't understand why I'm in any of this. Now, I want to get preachy here, but I'm just saying, know what you're doing, because you're giving up basis, big deal. You're giving up latitude in retirement, because remember, some of this stuff, a lot of things get taxed on your Social Security, and this is one of them. Qualified plans, huge.
Yeah, and the one thing you said there about the effective tax bracket, that's a great point. Most folks don't understand how our tax code works. If you are making $300,000, $400,000 and you think you're in the highest tax bracket, well, your effective tax bracket might be lower. I think I saw a study the other day that said most millionaires in this country really pay effective tax rates of maybe 20 to 22%, even though most folks think they're in the 39. So once you understand your effective tax bracket, then you can look back at your IRA. You've got standard deductions. You've got some tax breaks early on. One of the things we try and preach to a lot of folks is to do not overfund your 401k or IRA, because you're causing taxation not only on that later on, but taxation on Social Security, all kinds of other things. It's just a snowball effect. So really you want to look at, how am I putting money away? I'm not saying 401ks and IRAs are bad. Steve brought up a great point. You definitely want to take advantage of free money. If there is a match inside your 401k, listen, nobody else is going to give you free money.
Right.
Take it and run to the bank. But once you exceed that amount, it's time to start thinking about, do I still want to contribute in this manner, or should I take a look at doing some tax diversification? Because I'm 48, and so I plan to work for the next 15, 20 years. Are the taxes going to go up? I don't know. We have a lot of problems in this country. I think raising taxes cures a few of them. But I don't know if I want to keep contributing to a pot of money that I know is going to be 100% taxable 20 or 30 years down the road.
You brought up a huge point. I hardly ever see it brought up by registered investment advisors nor insurance professionals. We are sitting there. We need a 3-bucket strategy in distribution. I need non-qualified monies. Some of it will be tax deferred, not tax deductible. Some of it might come out tax free. We need 3 different phrases: taxable money, tax deferred money, tax free money.
You bet.
And we need all of them in retirement. And what it does is it gives you the power to execute what income you're going to take at any one point. And what's the big thing about that? Because you can manage your tax bill and keep a lot more money. And by the way, Ted believes this, I believe this. If you go to any of our seminars, we always talk about freeing up 10 to 15% more in cash flow every month if you'll just allow us to manage the tax bill.
Tax diversification is probably the most misreported or misunderstood piece out there. I sit down with a lot of folks that come into our office, late 60s, early 70s, they're retiring. They've got some cash in the bank, all right, which is not qualified, and then they're sitting on a huge 401k, IRA, 457s. And every time they want to dip in there to take a trip, to pay for something for the kids or the grandkids, we're taking out 20 to 25% more on the feds and maybe 2 or 3% more on the state, and they're getting hammered on taxes. We can't fix that problem now. It's too late. For a lot of the younger folks, though, we need to start looking at tax diversification. Non-qualified money, that's money in the bank, money you're going to use to spend, pay bills with. Qualified accounts, we want to keep funding 401ks and IRAs up to the point that it makes sense. And then we will need to start looking at alternative sources, Roth IRAs, the backdoor Roth IRA, cash value life insurance, where it comes out tax-free. So when I take that money down the road, I'm not paying any taxes on it.
I think it's a pretty critical issue because, again, if I'm getting a match from my employer, I'm taking it. That's a great deal, max contribution. And if I'm in the highest tax bracket in the land, let's say I don't have that many deductions or I'm under the phase-out provisions, I may be paying 30, 35, and on top of that, I'm not paying 20% capital gains. I have the Obama surcharge on top of that, so I might be paying 23.8. So all that is important to know. But the biggest one I want to talk about, because I cannot believe we've been talking about this for years, well, sooner or later, we're going to have to take constructive receipt of our qualified plans. In this case, you're talking about IRAs. At 70.5, the government says there's no more options. This is mandatory. Some people say, I don't need it, I don't want it, but I have to take it. This is another reason to talk about other things, other tax diversification issues. But 70.5, there's a penalty. Talk about that for a second so everybody understands what we're up against.
So when you hit 70.5, you are now required to take out what's called the minimum distribution from your IRA. It starts off, there's a factor table out there, which I always find interesting when I talk to folks. There's a table, and then we convert that table to percentage, because the table says first year, and it makes no sense, you got to take out 27.4 on your IRA. So you figure out your year-end balance of the previous year, divide that by 27.4. I've done the math. Here it is. It's 3.65%. That's what you need to take out. Every year, though, that factor gets lower. So it goes from 27 to 26 and 25 and 24 too and all that stuff. So people think it's going down. Well, actually, the percentage goes up. So you're starting at 3.6 when you're 70.5. And then in your mid-70s, in the 4 range. By late 70s, you're in 5, 6. By the time you get to mid-80s, it's 7 to 8%. By the time you get to 90,
because the amount's shrinking.
The amount is shrinking. It's the annuity payment for the government is what it is. They know that from now on, they're going to guarantee themselves this tax bill coming out of your IRA. And if you don't make that payment, if you forget about it, if you don't take out the amount that you're supposed to, then there is a penalty. I believe it's 50% of what you didn't take out.
So keep in mind, by the way, and we've fixed a couple people on this issue, if you're in your first year and you made a mistake and you didn't take out all that you needed to take out, we might, and I use the word might in parentheses, we might be able to fix that in the first year still. The IRS understands seniors and they kind of get this. So if you said, Steve, I didn't take out enough, I'm looking at 50% overcharge taxes on this, in the first year, we might be able to help you out. Okay. So when we're talking about an IRA, one last thing before I leave, remember, if you had an HSA account, this is just my little parting comment for the segment, you can transfer, if you're married and you're over 55, $75.50 under current code, you can transfer that to your HSA account out of your IRA. You know, your IRA was taxable. Now it's not. It's in your HSA account. And most of us in our seniors, we're going to use that money for medical. You could even use it for Medicare payments. I mean, there's a lot of cool things that are going on. So keep in mind, IRAs, the truth about it is, you may be partnering with the IRS whether you like it or not. Listen, don't forget to watch our next segment on How to Retire Happy, part 3 of our series on retirement tips for seniors. And keep in mind, before moving forward with any ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been listening to Steve Savant's Money. Let me go.